Hello and welcome to this latest edition of Courses on Demand brought to you by Forex.Academy. In this course, we will be discussing mastering breakout trading. There is, of course, inherent risk when deciding to trade the financial markets, so just before we begin, please do take a moment to familiarize yourself with the following disclaimer. First and foremost, we will look to focus our attention to outlining the main principles and practices of breakout trading. In mastering breakout trading, we must discuss why markets consolidate and what this means for future price discovery. And in applying those technical techniques to the various breakout trading setups visible in the market, we will discuss technical confirmation and attempts to avoid those false breakouts in the markets. We'll then look to consolidate these breakout trading techniques to both short and long-term trading opportunities. Now, first and foremost, to discuss the breakout trading principles, we have trade decisions that are made on a purely technical basis. And that's the point of breakout trading with regards to technical analysis. We don't discuss fundamental moves in the markets, perhaps economic data, perhaps a CPI report or unemployment report. We look at the chart and base all of our technical decisions off areas of interest in the market that we are observing. Trading opportunities are fewer as they ignore sideways moving markets. So if we are looking to only solely trade those breakout trading opportunities, we have to understand that we will forego perhaps shorter term trading opportunities, perhaps range trade opportunities with short-term volatility in movement. Opportunities focus on exploiting periods of congestion and price consolidation. And that's really the goal in terms of observing and preparing ourselves for identifying these potential opportunities within the marketplace. We're looking for periods where the market settles and perhaps where prices consolidate, so that when those periods of consolidation become much more mature and focused, that inevitably price will move away in such a strong structured manner that we're able to find these strong breakout opportunities. And trades, of course, assume more of a long-term approach with larger profits. It really makes no sense as a breakout trader to formulate an approach to perhaps taking 20 pip or 50 pip winners. What we're looking to do is position ourselves in the marketplace to look for larger opportunities, larger price moves as the markets break away from shorter term areas of price consolidation. So taking on the first main principle, this technical decision making. Why is it so important when discussing breakout trading principles? Well, for breakout strategies to work effectively, traders must position themselves in uniquely placed areas of the market. So we can't necessarily look and open up a price chart if the technical decisions do not stack up for us to look for those breakout trading opportunities. Decisions must be made on a completely technical basis, ignoring any potential short-term news events that may cause either short-term volatility or price action to move in a sideways fashion. This will help prevent false breakouts. Technical indicators like support and resistance levels and volume can provide very solid indications that the market is experiencing an increasing level of interest around such prices. So because we're deciding to look for these technical areas within the market in observing breakout opportunities, we'll very much look towards our technical analysis, things like levels of support and resistance, where we know many of traders are positioning perhaps to take advantage of stop losses and to look for stronger moves away from such areas of support and resistance. Quality over quantity. We know that when we're looking for these larger long-term trade opportunities, they don't obviously occur as much as the short-term volatility opportunities do within the markets. And that's necessarily how markets trade. Any financial market or asset will necessarily experience a period of low volatility. Then when an increase in volatility or price momentum enters the market, we'll see a breakout from the range. The market will then tend to range again, and so on and so forth. So financial markets do not break out as often as they trend or trade sideways. Patience is therefore a necessary attribute required for effective breakout trading. As the markets often trade in a range for a long period of time, they will often provide no breakout opportunity. And that's absolutely fine. We do have to accept as breakout strategists in attempting to master this skill of breakout trading that we need to take some patience into account, that these opportunities are not always visible and will not always occur. We need to be patient and actually let them develop in the marketplace. So our aim then of breakout trading when discussing quality over quantity is to identify and catch big moves that occur in the markets. A quality over quantity approach is thus applied to trading the financial markets as traders choose to forego potentially smaller profit opportunities. So, like I aforementioned there, we're not interested in short bursts or short pip movements. We're looking to have a well-structured failure or breakdown within the market that may allow us a breakout trading opportunity. Exploiting consolidation and stop losses is our next point when discussing breakout trading principles. And really, what it leads to is looking and observing the markets, whether you're deciding to trade forex markets or perhaps commodity markets. We will look for periods of price congestion or consolidation. The most convincing technical setups will more likely obviously provide the best breakout trading opportunities. Now, what do we mean when I say the most convincing technical setups? Well, after a period of volatility or trending, markets can often consolidate, leading to many traders keen to make short-term profits through this short-term price speculation. Technical indicators such as volume can reveal increased activity in trading during these times of price consolidation, which can lead to price congestion. So it's perhaps no different than trying to travel home during rush hour where there's a big traffic jam and you're trying to make your way home to your house, where you can see that there's a lot of participation on the street and you're trying your very best to break out from the participation and make it the fastest way home as possible. The financial markets are no different in terms of this price congestion as traders consolidate within a market looking for short-term price profit. A key principle of this breakout trading strategy is to exploit this price congestion when the trading range or historical level of support breaks down. As prices fail or break through these areas in the markets, the stop loss or short-term traders are hit, causing a further level of price movement in that same direction. So we aim to actually position ourselves as breakout traders, not just to look to follow the momentum of the primary move, but to exploit other traders in there that are perhaps making poor trading decisions. We can look to follow their stop losses and look for stronger price moves in that particular direction. Longer term trading equals larger profits, and it's certainly the case for breakout trading. We're not, as I say, interested in short profit targets at all. The objective is focused on identifying when markets break out from price structure. So really we're looking at the big moves in the markets and thus capture long-term price movement. A key principle is therefore to acknowledge a long-term approach to trading with larger profit targets. So with this, we know we're looking for a larger price movement, perhaps over the next 2 weeks. We're looking for the euro dollar, say for example, to move 400 pips. It may break out from a long-term range. That allows us to actively suggest where our stop loss, where our risk management should be in accordance with a risk ratio for a long-term price structure trade. So we're looking for those larger profits with breakout trading opportunities and foregoing or choosing to forego potential profits where short-term opportunities may lie. So here's an example of the euro pound daily charting. We have a very significant level of price consolidation and two support levels, one above that we can call a resistance level or perhaps a ceiling to the market at this stage, and a support level below which we could call the floor to the market at this stage in the market now. What we can see is we have a very active trading range in between where there is a lot of short-term profits if you're effectively able to trade the range. Now it is difficult, as you can see highlighted in green. Those are potential areas of identification where we look to actually identify breakout trading opportunities. Breakout trading here focuses on finding these opportunities when technical structures break down or fail. So in this example, I suppose the technical structure or breakdown would be when we have a confirmed break over support or resistance level to the upside or downside, and that would be indicative within these uh, green highlighted areas where the ranging market has become either overbought or oversold and is effectively exhausted. Breakout trading then involves these unique areas in the market in which to actually identify and position for these trading opportunities. When discussing price consolidation as well, a general rule of thumb we have when following breakout trading strategy and observing this consolidation is the longer a market consolidates, the more likely it is to break out and the stronger that breakout will be. So we have a few examples here. The first one just above, we obviously have a shorter range, a shorter trading range, which allows and affords the short-term trader to actually get involved and to make many trades throughout this range. Below, we have a much longer range, and obviously we would describe that as a much more mature uh, sideways period of consolidation or price consolidation within the market. And we have the inevitable break to the upside in both markets. What is suggestive of these two trends is the actual effect or the actual movement as price begins to break away from this range is effectively much stronger from the longer period of price consolidation. We're looking to maximize profits with a long-term trade. Perhaps we have more evidence to do that with the price structure below. So expectations on price breakouts increase as periods of consolidation or trading ranges mature. This can often lead to a breakout seeing a strong surge in volume and momentum. So when looking for these technical breakout strategies, we'll look at very significant levels or areas of interest and perhaps use some technical indications, perhaps volume or look for a surge in momentum if we use an oscillator to actually try and confirm with the candlestick structure a stronger breakout as opposed to deciphering either smaller breakouts or perhaps false breakouts. It is vitally important for traders to prepare in anticipation for strong price movement. And here we have an example with the middle of the chart. We're looking at the US Canadian dollar within this price chart here. We have a very consistent level of price consolidation. We don't see any false breakouts particularly, and we see it conforming within the actual trend structure with horizontal movement after a bullish trend. Um, Within this area, what we actually focus on with breakout trading strategies is preparation to our technical analysis. We can see there is price consolidation. Perhaps for some traders, they will be eager to actually involve themselves in trading these shorter up and down sideways movements of trying to buy the lows and sell the highs of this trading range. But we prepare as breakout trading strategists, and within this chart, we can see what happens next. Well, we have a very convincing breakout to the downside given the area or trading range has actually failed, and we see there's a strong confirmation with the bearish trend continuing. What we're actually looking to do is to actually capture this large price move, not concerned with trading the range within the consolidation itself. So price consolidation is so important because it allows us to observe and prepare for potential breakout opportunities. And the key when actually deciding and discussing price consolidation itself in an attempt to master breakout trading is preparation. That you need to be observing when these are occurring, when these areas of consolidation or congestion are occurring in the markets, and actually preempt or look to technically preempt a breakout from these areas. We see the breakout from the range again, moving quite strongly to the downside, and that allows us to capture a very large price move. Now, how do we first of all look for these opportunities within the ranges? How do we avoid false breakouts? And how do we ask ourselves, is there an area or is there discussion of technical confirmation that we can add in perhaps observing the Japanese candlestick price structure with the technical analysis to give us an extra element of confirmation to the trade? Well, as prices break away from consolidated areas of the market, we need to establish exactly when we want to enter and how to follow the momentum of price. First, we need to avoid these false breakout opportunities. So what we can see in the market just ahead of us there is a very convincing trading range price structure. Again, we have two levels of support and resistance, and highlighted in our red shadow there, we can see these false opportunities. If we were to, of course, be trading these opportunities, we would have actually taking many losers across this price range, and I can just highlight them in some extra detail here. If we were looking to follow the breakout opportunity to the upside, here with these opportunities we would have been provided with false signals, and conversely to the downside, as this as the price structure actually gives way and the technical support is broken, we look to try and capture this momentum. But each individual time it is actually a false signal, and we would have taken a small loser there from a break from the price action. So how do we actually look to avoid these false breakout opportunities? And how do we actually look to protect ourselves in actually using the technical analysis to confirm whether we're correct in terms of the breakout opportunity itself? Here, inevitably, we have, after a very mature range, a breakout from the range to the downside. And what we can see is with the candlestick structure itself that we can use patience and actually decide to use the close of the candlestick as it closes below the range. We can perhaps use the second candlestick as well, so that would be within this range, to actually give us our first and of course our second level of confirmation that we decide to enter the markets to the downside. It's really the first time we've seen continued momentum pushing the market past our level of support and resistance, and that would allow us for a position trade in terms of speculating for a very strong movement to the downside. So we can wait to observe the close of this candle to provide the technical confirmation, and that provides us with our short entry. So here we have a good example where we can visibly see some false breakouts in the markets. This is actually the German DAX, which is an equity index there in Germany, and we have some very consistent false breakouts to the downside. Here at our long-term level of technical support, we can see the level is breached, and they're actually within the daily candlesticks themselves. So short-term or intraday traders would actually look to follow the momentum to the downside, trading these markets heavily to the downside, looking for short-term profits or potentially trying to capture the next breakout to the downside. But within each trading day or period, we can see that the market closes just above or at a resistance level, so it doesn't give us a very good technical setup in terms of momentum, looking to follow momentum to the downside. What is significant is inevitably a breakout from the range, and we can see highlighted with our circle there that we have an engulfing Marubozu candle to the downside, a bearish engulfing candle, and that would be a very strong signal to us that we can look to perhaps continue to sell from the close of this candle, looking for large price movement speculation over the medium term, as opposed to looking for short-term trading opportunities. One of the major benefits to breakout trading is that it can actually be applied to trading different time periods. So whether you're deciding to look for larger breakout trading opportunities in terms of applying it to perhaps weekly or daily candlesticks, we can actually use the same very constructive trading strategy to position yourself for shorter term intraday breakouts, perhaps looking at 15-minute candles, at 1 hour candles perhaps. Within this example here, we're looking at the euro, Australian dollar, and we can see actually with the M5 there that it's actually observing 5-minute candlestick structures. So here, as the chart trades from left to right, we can see that we have smaller trading ranges starting to develop within the price structure itself, and that could lead us for very short-term opportunities. So if you do decide to look for trading breakout opportunities, you can break it down into smaller time frames and actually look for short-term profits if you're a short-term profit trader, but it's all indicative of the price action itself. So again, we have a bit of a break to the upside that could actually provide you with a short-term profit, even though the aim was perhaps a profit target up to here. Again, as we see the structure start to form with another shorter term technical structure or level of price congestion, we see that there's another breakout to the upside, and evidently we get a breakout from the range. Price moves up to new highs, and we can look to settle perhaps with a profit target around here. So within the actual daily candlestick itself, we are provided with very good breakout, shorter term breakout trading opportunities. Then we can see another very constructive price setup in the market exists. This time it's actually a technical level of support that begins to form in the markets. We get a false breakout unfortunately to the downside, but again, we don't necessarily get the confirmation. We get one close just below the candle and there is no continuation. So that would be a poor signal in terms of accepting the trade to the downside. Then the market trades up strongly. Evidently, when it comes back down to our price structure and closes above the technical level of support and resistance, we get a second close, and that would constitute a very strong um, intraday short-term breakout trading opportunity with a break from support. So as seen in the last chart there, traders are effectively able to use breakout trading strategies over different time frames. In deciding to trade these shorter time frames, traders can look for low periods of volatility when the market is trading horizontally or in the long term. And the reason we would do this is to actually look for these areas of price consolidation so that we can position for the breakout trading opportunities. We need to incorporate technical confirmation to the trading strategy, and that will increase the probability of traders identifying successful breakout trades. And that is conducive of observing not just the technical analysis, but the structure of the Japanese candlesticks as they close either below or above your technical levels of support or trading range. Traders who focus on intraday swing trading will are able then to profit from short-term volatility. So if you're trying to position yourself for the longer term trade, certainly you won't be interested in swing trading volatility, but perhaps if you're looking to trade those intraday swings, perhaps over shorter time periods, you can certainly use the same technical approach in terms of mastering breakout trading to those shorter time frames. So here we have a long-term breakout opportunity, and it's very well defined in terms of the structure. Again, we have a technical resistance and a technical support, and this is actually over a long-term commodity market where we see the price, and not once but twice, actually bounce off our level of support and resistance. So here we have a signal that we don't actually get to either sell the market, given that it doesn't touch our level of support and resistance. But in terms of the breakout strategy, we don't even get to meet the price structure within our area of interest. The second time we do, again, we get the market trading up and it actually closes above the technical level of support but doesn't continue. Price doesn't actually continue the momentum to push on through our area of interest and perhaps give us the confirmation just above our level. And the third time, evidently, it does come up within this price structure. We get a close, we get a further bit of volatility with a close, and then perhaps this is our first and second confirmation. So we can see there is a very consistent plan that we have in action in terms of breaking the technical level of resistance over the long-term price structure. It is the breakout opportunity that we have seen one or two failed breakout opportunities there within the same technical level, and evidently as the price trading range becomes much more mature, when there is a push of momentum and we get the second confirmation, then we can look to actually capture these long-term opportunities. And this is evidently when the market decides to trade very strongly to the upside indeed. So in our assessment of mastering breakout trading strategy, we first and foremost looked at the breakout trading principles. That includes our price consolidation. We're looking to take advantage of stop losses and look for particular areas of interest in the markets. That leads us on to both technical confirmation and trying to avoid a false breakout so that we can actually look to the structure of the Japanese candlesticks to give us that added level of confirmation that indeed these technical trading decisions are correct and that we're looking to only capture the best technical setups. We then looked at both how to trade these opportunities intraday and with long-term trading opportunities. So more often than not, most of these opportunities are applicable to long-term breakout opportunities, perhaps in a commodity or a forex. But when we actually break down technically, because we can apply the technical setup primarily based on the Japanese candlesticks and their technical qualities, we can actually look to trade these in shorter time periods, perhaps intraday over 5 minutes, 15 minutes, or perhaps 1 hour candlesticks. That concludes this lesson on mastering breakout trading. Thank you very much for joining us on this installment of Courses on Demand brought to you by Forex Academy. We do hope to see you very soon. Bye for now.